Hey, everybody, good evening. February 21st, kind of late at night, Eastern Standard Time, going on 10 p.m. I've had a couple of thoughts in mind I wanted to put on video for the last couple of days, and now is as good of time as any. And I just want to talk a bit about trading versus investing. And I see a lot of mistakes as a newsletter writer from a lot of people. I make them myself. I'm always learning. That's why I love the capital markets due to the human psychology factor, sociology, a lot of different emotional swings that end up occurring. And you can't really be a terrific speculator or trader or investor unless you've got some stability within, some clarity within, and also defining your goals and your objectives before you buy whatever you're going to buy. I think that this is a really important thing, but we're seeing it. I see it in a bunch of different areas, but right now it's actually really evident where I've been observing this cryptocurrency area. And I bring this up because this isn't going to be crypto focused, but it is very relevant because there's a lot of new traders and new people that are investing for the first time in the crypto space. And, it's kind of like I cringe and bite my tongue when I see some of the comments that come forward. I'm in a couple of the groups on Facebook, watch some of the tweets and kind of the interactions that people are having with the gurus, looking for guidance. And it's painful because they don't have a clue what they're doing. They have no idea. And the markets are the markets, and they're an expensive teacher. So hopefully, a lot of these people are not going to stick with it. They're going to say they thought there was easy money on the table, and they're finding out that that wasn't the case. Just go ask somebody who got, referred to Bitcoin at 18,000 and see how they're feeling, or how they were feeling, or if they even held on when it plummeted to 6,000, down 70% in less than 2 months. This is real money, and it's serious business, and the pros win. The pros win. And how do they win? How do we win? I'm one of them. I've been doing this since I was 20 years old as a professional stockbroker. Before that, in high school, I started as an intern at Merrill Lynch in Milwaukee, Wisconsin, worked for other large brokers throughout college, and left college early and had an opportunity to become a stockbroker. And so I had to learn a lot of lessons on the job. And even if you get an education, when you start to work with real money and real other people's money, it's a whole different ballgame. And if it's your money, that's just as good, if not more, hitting home. But one of the things that I learned, and I see a lot of this now in these areas, and this is going to happen. The reason I think it's important to bring this up is because it's going to happen again in the gold and silver arena when things are flying, and they're flying high, and they're running hard, and they're strong as can be, and they're galloping like a gazelle. People are going to chase. They're going to chase. They're going to jump in at the top, and they're going to buy high, and they're going to sell low. And it's going to be the same type of activity that we see over and over and over with mistakes that people make. And I had a client when I was probably 21. To me, he was a huge client. They were a family that owned a construction company in Illinois. And I got a call. I forgot what ended up happening. I think it was because I cold called this guy for a year and kept leaving messages, and he always blew me off. But then Revlon was going public, and he called up. I walked in one day. I think it was one of those days where, one of those weeks or months, I had no money. I was literally clinging to survive, and I got a break. And he called. My manager said, "This guy called. You should call him back. He wants to buy Revlon today." So I called him up, and he wanted to buy 1,000 shares, and it was trading at about 29. So 29 grand with what we were working with a lot of the lower price stocks. If I got a new account for $5,000 or $10,000 in a stock, that was pretty good, for a starting point. And here this guy was plopping down 29, and it was just getting started. So he wanted to trade, and he wanted to buy Revlon that day, and he wanted to trade it. But so what ended up happening is that every day he wanted to trade. He became my best buddy. He called me every day. I called him a bunch of times a day, and I had to find ideas. And we basically both were new. I mean, I was new in the business and I didn't really know much better. I was very ambitious and I had some really good winners and some good calls, but I also, as far as like trading, real live in the mix trading, I had a lot of lessons to learn. And one of them was, one of our sources really was like, he would find the hot stock of the day or of the week, by looking at like the percentage gainers. I was doing that too. I was looking at what's moving and what has the ability to continue to keep moving. And so we bought a lot of stocks towards the top and then ended up stopping out with, 10, 15, 20, 25% losses after they would cool off. And it was just not a really good strategy at all. We had some winners in there too, but from an overall standpoint, it's not a way to make money. I think you have really got to do a few things and define, when you go into a stock or an ETF or a precious metal or a cryptocurrency, define whether or not you are trading with that money or you're investing. Because to me, there are very, very two different mentalities to make sure that those approaches are successful. And these are generalizations. There's obviously specific and unique opportunities, but I bring this up because I have a lot of companies that I'm invested in that I just try not to touch for a long time. Because, for example, if you're investing on the theme of a fundamental theme or a secular theme, meaning, you found a company that has really strong growth and their earnings are flying and you think that they're going to continue to fly. It's just a high growth situation and it's not done yet. If you have a sector that is cyclical, like gold and silver, and you buy early in a bull market or you buy at the end of a bear market, and you're waiting for that bull market to come back and things to kick back into gear to take your profits, that's another way to look at it. Another one would be contrarian, which could be as simple as like the uranium sector right now, which has been beaten down for quite a long time. It's very cheap and it's cyclical as well, and it will turn back up at some point. So if you buy those uranium plays now, you're doing it based on something that I really don't know when it's going to happen. Calling the timing on something like that when we're this far into it, it's just really difficult to do. You see some initial moves, and I think it's when you see some life at all, it does give you the opportunity to say, hey, now is the time. It's getting closer. We did that a year ago, and it was a false start. But I say that because those are not trading situations. If you want to get rich investing in stocks, especially in the small stocks and the junior mining companies and the cyclical industries, you have to hold them for as long as you can into the duration of the bull cycle. The fact of the matter is, this is what people just do not understand. The sector itself, the general market and the sector itself is going to determine 90% of the movement of any particular company's stock in this sector. 10%, maybe 15, goes toward the individual company's performance. That's what puts the cherry on top. That's what brings in companies that outperform versus don't perform well. But you see it all the time. I mean, you look at I look at some of these new people when they're commenting on the cryptos, and then they talk about manipulation because all the altcoins are down when Bitcoin's down. Oh, look at this. It's obviously not a coincidence that they're all falling together, at this time. They're all down today and they were all down yesterday, and then they go right back up together. Well, listen, this is 101 type of stuff in terms of sectors trading together. And so it's really important. And I think this goes into people ask too many questions about why is a particular company's stock off on a particular day, especially when you get into the junior plays, because, if there's not a lot of volume there in particular, it's probably nothing. There's not always a reason why. They trade. These are stocks. These are markets. They trade up and down. But anyway, I think that from an investment standpoint, if I were to say buy a position now, and I say to myself, I want to have X amount allocated into gold, silver, and gold and silver stocks. What are the amounts or percentages that I want to have allocated to the juniors? If it's going to be in the juniors, what's the maximum I'm going to put in any one particular story? You have these numbers generally sought out for yourself, and say you identify a company at any point in time that you want to take a position in. Let's say it's Gungnir at 10, 12 cents. Here's the thing. If you're investing in that company, you don't blow your whole wad on one purchase at one point in time in history. It's not wise to do it. And part of it is psychological. What do I mean? I mean that if you go into say you have 10 grand to put into Gungnir Resources, you buy your initial $5,000 because in general, it's very cheap. It also has been much, much cheaper. And gold is still testing that breakout level of 1350 to 1375 until it breaks that 1375, which is literally game on, and everybody's going to know it's game on, and everything is going to start flying. Until then, there's always a chance that it could go back and retest lows at the bottom of the channel. Who knows? These are key technical areas. You don't have to get into this stuff, into the minutia, but this is an important one. This is looking at like a 10-year chart. As I've pointed out many times, it's broken out of that flag consolidation, but it's been testing the top of that for a while. I think, we're very, very close, but, anything can happen on any given day. It could be a liquidity run in the markets in general. It could be that gold gets smacked for whatever reason, and then the gold stocks have been acting weak. So what you want to be in a position to do is that if it goes lower, you buy more, and you're actually pleased about it because you're going to own more stock that's going to actually pay off in the long run. You're going to own more of it. And if it gets really cheap, you're going to be licking your chops and be able to deploy more capital and build a bigger position cheaper when nothing has changed fundamentally with that particular investment theme. And in most of these cases, the companies have improved. If it's over a period of time of a year, say you buy some of these stocks at X price, $1 a share, and then the company moves forward with drilling and they have some decent success, good success, and gold's higher, and then all of a sudden, for whatever reason, the sector is weak and the stock is trading at 65, 70 cents. You want that opportunity. You want to embrace that opportunity. You don't want to sit there and act dumbfounded, like what's wrong with this particular company, because there is nothing wrong with it. It's just the fluctuations in the cyclical aspect of the sector in general and the markets. And it might be to that specific company. The small ones can move up and down percentage-wise quite a bit from even one or two big buyers or sellers on a day where it's illiquid. You want to take advantage of those disjoints in the market. For example, you could have in what they call stink bids. You buy Gungnir at 10, 12 cents, turn around and go ahead and put in a stink bid at 6 or 7 cents. You've got it in there, and maybe one day somebody steps in and goes, screw this thing. I need to unload 500,000 shares. It's a thin market, and it dumps down, you get filled, and it goes right back up to 10, 12 cents. It happens, but you have to be prepared for these things, and you have to know what your strategy is. The difference with trading is that with trading, it's completely different. You need to cut your losses. This is the biggest mistake that people make in the trading area that I made for a long period of time until I implemented stop loss limits. And whether it's mental or you put it in literally, because with some of the small, tiny ones, it's hard. It's hard to put in stop loss limits. I'm talking about trading positions, which are going to be more liquid and probably listed companies. So you could go from MUX to Freeport-McMoRan to Newmont, some of these type of plays, First Majestic, big companies, multi-billion-dollar companies, listed, liquid. And if you want to go into those for a trade, then you're going to want to define that. Like, what is my downside risk right now? What is my upside? If I'm going to have a 12% stop loss limit in there, stick to it. The whole key with trading profitably, consistently, in my experience, is that you have to let your winners ride and you have to cut your losses quickly. It's very, very simple. It's not always easy to implement, but it's a different mentality. So if I end up going into, like I just did this recently with First Majestic, the market was starting to, it got hurt. The thing flushed down to like $5 or something. And it was huge. It was a big jump down, and it was basically, there was no news. There was nothing wrong with silver or gold. So I loaded up on margin, And I'm down a lot. I mean, if you look at my one particular corporate account with First Majestic, I think I have like 30,000 shares in there, and it's down probably 40 grand. I'm down more than a point and a quarter on my cost average. That can be made up very quickly, so I'm not too worried about it. But when it jumped back up to 6 really quickly, I'm like, okay, we might be game on. But then when we started to fall back off, I said, you know what? I'm already up on the trading position. I'm too overexposed. I'm just going to cut it. I'm going to go back. I don't have any clarity here. I'm going to cut that position back down to where I have my core position, and I'm ready to put it back on a trading side if the circumstances end up warranting it. But psychologically, I see this a lot. It's just focusing more on the investing side, which is where the big money's made. It's just a shame because so many people don't have the patience to see something through. And I know this well. Back in 2000 and it was probably 2004, 2000 and I don't know when it was exactly. It was probably a year and a half before the real estate market and the entire meltdown occurred. I was a broker, and I actually got some clients into this too. And we started to short the mortgage companies. And I had a bunch of big mortgage executives as clients, and I verified with them that it was a house of cards. I mean, I had inside insight, and I knew this thing was a complete bubble and sham, and it was going to explode and crumble. But I didn't have a lot of capital at that time. I didn't have a lot of staying power, and I was moving around too much and different opportunities. So I started to buy puts on companies like Accredited Home Loan was the symbol. That was the most leveraged piece of crap I could find. But anyway, after I started to short it, Kramer came on and pumped it up, and it went up about $5 or $10 a share. And if I had the discipline and the ability to stick with my theme, I would have shorted more. I would have found the money. I would have gotten more, and even if it was a small amount, continued to buy more puts and see it through. And that's where you had people like John Paulson and these companies that are the hedge funds that went out on a limb and they started to buy the CDOs. And basically, they were baffled for a period of time. They had to see this through, and it was not easy to make all that money. And I know that firsthand. But at the same time, you can learn from that. And I think that with gold and silver right now, this is a perfect example of where, we had this big run in 2016 after a terrible bear market. We've been basically weak, more or less, since then. But gold itself is holding up and is actually looking pretty decent, pretty strong, in fact, in the face of record high stock market, continuing easy money, cryptocurrency bull market, real estate bullishness. I mean, gold is typically not going to end up rocking and rolling in that type of an environment, but here we are at close to highs. So our theme about why gold is going higher, and really you could put it as simply as after a bear market, it's a bull market, and we're 2 years into a new bull market. And these things are going to last a lot longer. And we're nowhere near what would be the euphoric phase. In fact, I would argue that the dismay in this market, the disgust, the bearishness, the fear is those things are very high, which would actually talk more to sentiment being ripe for a very, very strong bull move versus there being a lot of enthusiasm and being ripe for a pullback. But this type of thing, even when you look at sentiment, is a good it's a good message to latch onto, in that usually contrary action is where big profits are made. It's when you can make moves against the crowd, and you can actually take those actions when you may not feel like it. And when other people don't agree with you, I mean, that's where you're going to end up making the most money. But I would just say that, for example, I have a lot of friends or people that I'll talk to intermittently that, whether it was with the cryptocurrencies or, I still have friends that from 2010, 11, that were long, whether it was the GDXJ or Silver Wheaton. I know one of my friends they have McEwen Mining and stuff like that. And I talked to them when the market started to rip again in 2016. I said, we're game on again. This thing is, the new bull has started. Have you been buying more? No, but I'm holding what I have. I held through the whole debacle. Well, that's just crazy. Why aren't you going to take advantage of a market that has caused you to suffer for longer than you wanted to and deploy some capital into cheap securities when you know this sector, you've been watching it and know it better than most, and a lot of institutional investors and big money does not have allocations in this space with precious metals. They will, and it will increase, and it is increasing slowly, but you're the one who knows this stuff. You can tell when it's cheap, you know that it's cheap, and you have to take some action. It doesn't have to be your life savings. It could be a very modest amount, but the fact that these people say, well, I'm holding, like it's a good thing, I want to smack them and say, if you're not doubling down or taking advantage of the cheap prices here, you're going to really regret it, because they're going to probably, I know these people, they're going to be buying more at the highs. It'll happen. It happens every time. So a couple of other notes here. One of the reasons why I'm really liking this crypto market for trading is A, it's extremely volatile, which is great for traders. And B, I'm noticing how many people just do not know what they're doing at all. And that really ends up, I'm talking about just the trading aspect of it even, looking at charts, something's overbought, it's oversold. RSI, moving averages. I mean, these are things that a lot of these people are just starting to learn about. And so what I think is happening is that because you have so many new people that are in, that's why we saw such a euphoric blow off top in December. And then that's why we also saw a 70% decline in the course of 6-7 weeks. It's very, very pronounced because emotions from beginners are fueling the market up and fueling it down. And that is a recipe for profit for people that have their head on their shoulders and can actually take action in buying positions when things look terrible. And there's going to be some real aggressive flush outs in this market, whether it's going to go up or down. And those are going to be really good buying opportunities because a lot of these new people are just going to get sucked out of it at the lows. I mean, the amount of people that were new that probably dumped at $6,000 Bitcoin right before it doubled, essentially, a lot of them, it's a lot of small investors. So I would say that if you are a trader, you do want to, get involved to some degree in the cryptocurrencies because there is a lot of action there for trading. One other thing I want to talk about too is, getting away from the question of why is this up or down today? Why is the stock market up today? Why is it down? This is what the mainstream media does, is they try to explain why something is moving on a particular day, and they actually have no idea. There are things that influence the market, yes, but stocks fluctuate. This is what they do. They have trends within trends of themselves. They have patterns and they have movement. And so it's not like you can say every day that there's a cause and effect for exactly what is happening in a particular company or stock. And it's not usually, and I'm looking at the juniors now, like the juniors today, they're weak. They're very weak. They've been weak. And if one of them prints lower, for example, I had a couple of people that have asked me about Valterra recently. One of them actually asked what's going on. It's up 20-some% today. I think that was the day before that somebody else emailed me because it printed that it was down 20% or something. But this was on the US market. I've done a video on this about how this ends up happening with a gray sheet or an OTC company that's really primarily a Canadian stock that's barely trading. You'll get these big print, divergences because something's trading at like $0.015 to 2.5 cents on the US market, and it's trading at 3 cents on the Canadian market. And then you're printing them at these crazy levels from a percentage basis if you're buying it versus selling it. And so you'll see a company like a Valterra trade like 5,000 shares. I mean, it's like It's not even $1,000, and it'll show that it's up 20% or down, 25%, and it is absolutely meaningless. I mean, I have people that are actually pros in this business with regard to some of these companies. I'm baffled when they hit me up and say, what's going on with this? And I say to myself, just look at the volume. If there's a lot of volume, something's going on, fine, shoot me an email. If I know anything, I'll let you know. But if there's nothing trading, it's useless. It's utterly meaningless. That's like when you have the U.S. component on JagerCorp, which is a penny stock that we've been in for a long time. We'll see that thing print at 2.021 cents one day, and then it prints at a penny or 0.012 the next day on like 500 shares, 1,000 shares, just some little stupid transaction that's going on. And the Canadian market, which is the one that counts, hasn't even moved an inch. And my account value, so this is where it gets people, my account value, because I have one account with like 2 million shares of that thing, it'll end up making a difference where I get a $20,000, $25,000 hit in my account value. I wake up one day and I say, whoa, what's going on? And I look at all my main positions, on one account. And if I look at the market quick, I can determine, it's probably freaking JagerCorp. Somebody printed it at the bottom. It has nothing to do with what the company is doing. Nothing, zero, nothing at all. And so getting, even worked up or taking any of your time out of that stuff, it's a waste. And, so asking about why is this, why is that? Sometimes that's important, but 90% of the time, there's no why. Or if there is a why, what's the answer? The market's down. The sector's down. The sector's up. The sector's up. I mean, if you have like today, I bought like 10,000 shares of Timberline Resources at 18 cents US. So it printed up like 20%, maybe more, because it was printed yesterday at 15. So what is that? 20%. It's up 20%. I was surprised I didn't get any emails. What's going on with Timberline? It's up 20%. Nothing. I just bought 10,000 shares on the offer. It's like, there's no news. There's nothing out yet. So in any event, I really do believe that the most difficult part about what we're doing at the Gold Investment Letter is going to be when to sell. When to buy it's not that hard. If you can be patient and not worry about the day in and the day out and the week in and the week out movement of these stocks, it's fun. It's fun to watch them. But if you're sweating it, you're going to be a piker your whole life. And that means that you are essentially going to sweat these small moves on companies that are built, they're designed for volatility, and they're going to move all over the place. If you don't have a disciplined plan to end up holding through thick and thin until, say, for example, X amount of your portfolio is going to be allocated for when you think gold is topped, that's when I'm going to actually come out with an alert and say, I just sold 50% of all my securities in this sector today, because I think we're getting close to the top in gold. And if I'm really on point, I'm going to be not even really near the top, because nobody's going to pick that. If you're always waiting to get to sell at the high print and buy at the absolute bottom, when it's down at the bottom, you're going to be thinking it's going lower. And then when it's at the top, you're going to be thinking it's going higher. And you're going to firmly believe that because you're going to feel that way. But what I'm saying is that selling is going to be the tricky part. If you buy a stock today, like Gungnir at 11, 12 cents Canadian, or Southern Silver at 30 cents, McEwen Mining at 210 US, Ely Gold at a dime, etc. I have no doubt in my mind, you're going to have plenty of opportunities to sell those stocks at much higher prices. The question is, do you buy like Ely at a dime and then it goes up to 15 cents and you have a 50% profit, which isn't bad at all? Do you sell it and then move on to the next one? Or is that one of those core investment holdings, even if it's a small position because it's a small company, where you're going to maybe sell up to half of it at a double or a third of it at a triple to take your principal out and free up some capital? But then that goes into the bucket of top of the market, whenever that is, it's not going to really have anything to do with Ely. You'll free it all up if they get bought out or there's some sort of an event. But you have to define these type of things. And I think that's going to be the hard part. Buying these stocks here is not the hard part. They're going to end up going higher. It's just a question of when and how high do they go. So stick with the plan there. And I think, part of this is just to remind everyone that having a plan, defining why you're buying something, as simple as, is this a trade for me or is this an investment? I have a lot of stocks where I have a certain percentage of it is an investment. I'm not touching it. But then an opportunity presents itself to trade because it got overextended in one way or the other. So then I have cream on top of that, where I'll end up like with First Majestic. I have X amount of shares. That's my long-term core portfolio. I don't want to touch it. But on top of that, when I saw an opportunity, I loaded up on it. But that's my flexible stock. That's going to get flipped. And I'm going to get paid for my time, for my suffering. But it's defined. I know it more or less. I have some flexibility with that plan. But when it comes down to having my core portfolio, it also is very helpful for me when I do these private placements. I've got 4 certificates here. I've got 6 certificates in process to my broker. And, some of these are probably, I look at Castle Silver, Timberline Resources. This was dated in March 17 for Timberline. Castle was last summer. Some of these are just, I haven't even tried to deposit them in almost a year because these are my long-term core holdings. And I'm in no rush. I'm in no rush at all. They're nowhere near the prices that I want to end up selling. Castle's up. It's already doubled. I do want to get it deposited. If it ends up going to 60 cents and it's a triple from where I put that money in and we have the warrants, I might sell a third. I might just take my principal out of that, but holding the rest. And anyway, I look at that because the private placements, when you get the certificates and you have to have a little bit of the pain in the butt to deposit those shares and everything else, it's not necessarily a bad thing if it takes you longer, because whether things are going up or they're going down, once we're eventually right and a bull market kicks into gear, it's going to have various phases that it's going to continue to go to, which will end typically in a euphoric, manic sort of phase. And that's what's going to happen with gold and silver stocks at some juncture. And so, forgot that train of thought, and I've talked a little bit more than I wanted to tonight. So hopefully some of this content was helpful for you, and I hope you're all doing well. Have a good night.